Hello, everybody. Welcome to the Next Wave webinar of launching a CVC, Startup Fundamentals. I'm pleased to have some outstanding panelists together, and I'll introduce them in a little bit. My name is Lee Sessions. I'm with the GCV Institute. I'm one of the course directors, and I lead our CVC ecosystem development, and I'll be moderating the panel today. As I mentioned, we have some outstanding panelists, and I'll introduce them in just a few minutes and have them talk a little bit more about themselves. But first, I want to provide a little bit of framing for the discussion that we're going to have. This is a popular topic and the first of a three-part series about operating a high-performing CVC. So first of all, just a little refresh and some context about the role that CVCs play in the VC ecosystem. CVC has been growing consistently year over year for many years. We saw it last year in 2025, another 46 units formed. They are represented in nearly every industry and account for about 20% of deals annually and contribute about more than half of deal volume each year. So growing in importance, growing in numbers, and growing globally as every industry is becoming kind of a digital organization and benefiting from new technologies. CVCs are really good for entrepreneurs and startups. We see that companies that have CVC backing are less likely to go bankrupt and more likely to have a positive exit over time. So good news for operators of startup companies that can secure CVC backing. And so there's good news there. With CVC programs, we'll talk about this with the panelists and ask questions about each of these things. But the whole process of establishing and operating a CVC program revolves around its charter. What are your objectives, your investment themes, your innovation horizons, the reasons for establishing your corporate venturing program? And then there's four other main categories of things that we look at. One is your whole approach to innovation partnering, who you work with internally and externally to execute the process of investing and realizing the value from those investments that you make. We'll also talk about the investment process, including the operating models, the way you structure your CVC, and the way that the corporate venture investing team and the corporate venture building teams work to provide the integration and the governance with the corporate parent, the way you engage with your corporate parent partners in the venture program. It also takes a professional team. CVC is no longer an amateur sport, but a really professional sport that has with it a set of expectations for high-performing individuals who are necessary to operate the CVC at various levels. And the engagement of the right people at the right time is really important. And then lastly, we'll also talk a little bit about performance metrics, both financial and strategic. So that's just a little bit of framing for the overall process. We have three major maturity program phases that we see. And this comes from work that started with the Bell Mason Group many years ago and is core to what we cover in the GCV Institute. But the three phases are startup, which usually lasts the first 3 years or so, then expansion, and then resiliency. And as I mentioned, this is part of a three-part series. Today, we're talking really about the first 3 years, of which a lot of things need to happen pre-start and in the first 18 months. So that's what a lot of our questions will cover. But when we talk about the startup phase, what we're really talking about here is that critical phase when you need to kind of get the proof of concept right and get it up and running to the satisfaction of your key corporate stakeholders. And really, you're making the case to be able to expand and grow and institutionalize your program, which is years 4 through 6. And then once you've survived that long, then you can move into more of a resiliency phase where you can really optimize your program over the years. Our panelists will talk a little bit about their experience because all of them have worked with multiple CVCs at multiple maturity phases. But the real thing to think about in this as you're starting a program is how you're going to secure the internal and external respect for you to be able to execute on the deals that you want to do to support your corporate venturing program for your corporate parents, as well as have credibility with the entrepreneurial community that you are working with to secure good deals. And so we'll talk a lot about kind of the key elements of your operating style, what performance metrics are important, especially at the beginning, and what some of the key challenges are. And luckily, our panel participants have had to deal with many of these challenges, and we'll share some of the war stories and things that you need to watch out for if you want to be successful in an enduring program. You know, when people enter this, they enter into it with great ambitions, and there's an overwhelming amount of things to do in the early stages. So one of the things that they'll talk about is what they prioritized and when. Corporate venturing takes place in a very complex ecosystem with many interdependencies. I think this is what makes corporate venturing so challenging and so fun. So when you think about it, corporate venturing starts with the investing team in the core executing on the charter of the organization. And they oftentimes engage and have a part of their team that's devoted to landing that value, the corporate venture business development team or a platform team that helps to secure the wins with the business groups. And one of the things that makes this whole end-to-end landscape so challenging is that the corporate venturing team in the center has to deal with external ecosystem partners in the industry, including other co-investors, other VCs and CVCs, startups and accelerators and so on, along with other external entrepreneurs. At the other end of the spectrum, they're dealing deeply in the bowels of various business groups where they have a different set of expectations, oftentimes a different language and a different time frame. At the same time, most corporate venturing groups report to the highest levels of executives in a corporation, usually the C-suite, sometimes the board or the CEO or the CFO or the chief strategy organization. And they have to deal with the parent corporate shared services, finance and purchasing, logistics and HR. So this interdependencies, all of the little arrows back and forth that take place over a period of years is what makes this so challenging, as you're managing hundreds of interdependent relationships in different ecosystems where they may not even speak the same language or have a common understanding of what the objectives are. And one of the things that you do in the early stages of forming your venture team is start to map out and manage those relationships so you can get things over the starting line and develop an enduring organization. So lastly, we will talk briefly about metrics as we go, some of the early stage metrics that you want to have. Everybody starts a venturing team for the reasons of developing strategic impact, to impact strategy and growth for their corporation. But it is important throughout to always remember that you need to pay attention to the financial table stakes using competitive VC performance metrics. And there's also some operational metrics to keep your eye on as you go through that whole process. So we'll touch on some of those things throughout our conversation. But without any further ado, I'd like to welcome our three panelists. We have some outstanding leaders who have a wealth of experience in starting and working with multiple VCs, CVCs. Let me start by having Jonathan from Fenwick introduce himself and tell you a little bit about his background.
Thanks, Lee. Hi, everyone. Thank you so much for joining. My name is Jonathan Saget, and I'm a partner in the startup and venture group at Fenwick & West, based in New York City, as you can tell from this lovely background behind me. I've been practicing for about 20 years, and I've spent most of that time working with strategic and corporate venture investors. I've spent about 15 years also working on the startup side, and I've worked with CVCs in all sorts of different verticals, from advertising to consumer products, fashion, beauty, beverage, and now working with some of the largest companies in the world, dealing with the AI boom and making their investments there, defense tech, gov tech, fintech. It's really been a broad basis for me. And I spend about half of my time working with startups on the company side, where I represent companies at all different stages of growth, and in all different verticals focused on tech and life science, because these are all venture-backed businesses, where I act as general outside counsel. I've been working with GCV for many years now. I've been at Fenwick for about 8 years, and it's really been a pleasure. So I'm looking forward to today's conversation.
Great. Well, thank you, Jonathan. Dan, you're next.
Great. Thanks, Lee, and thanks for that intro. Really summarized kind of different stages of CVC very well. I'm looking forward to this discussion. My name is Dan Atea. I lead RTX Ventures. We're the corporate venture capital group for RTX Corporation, which you may know are three main businesses: Raytheon, Pratt & Whitney, and Collins Aerospace, roughly each a third of our overall business. I have a technical background originally. I was doing R&D for several years at the Naval Research Laboratory in Washington, D.C. So defense tech start in my career. I then spent about 12 years at 3M, the brunt of which was in 3M Ventures, but also I ran an internal venture and was in corporate strategy for a little while there. And there we invested in, I don't know, about 35 to 40 companies that covered deep tech and industrial tech broadly. And I really got involved heavily with GCV and learned a lot about best practices, looking across the industry at how different companies formed and ran their groups. Learned a ton. And then about 4.5 years ago, found this opportunity where RTX was looking to start a venture group and really brought together that defense tech interest that I've had my whole career, broad range of technologies that I have interest in, and an ability to help start a new CVC from the ground up, which was very exciting. So we're well into our journey. I agree with those stages that Lee said. Happy to talk about that. We're now kind of in this expansion phase after really getting this group set up, and looking forward to this discussion. Thanks.
All right. Thank you, Dan. And Laurel.
Hi, everyone. Thanks so much, Lee. Really glad to be here. Laurel Buckner from BHP Ventures. Some of you may know BHP. We're a 140-year-old mining company based in Melbourne, Australia, with our main assets being in Australia, Chile, and a large mine in potash coming online in Canada, with commodities in iron ore, copper, gold, silver, and uranium. So very exciting time for critical minerals, and an exciting time to run the corporate venture capital group here at BHP. I started at BHP just about 3 years ago. I'm on my third year, but have been in corporate venture and investing for some time. I started my career as an attorney. I'm based actually in Seattle, Washington. I started my career actually as a tax lawyer and corporate lawyer, went in-house at a technology startup, and then through a series of acquisitions, sold a large company in a large transaction in 2012 and became an investor after that. Known Lee since my early days in corporate venture capital when I built my first corporate venture capital fund in 2013, and did some private fund work, and I'm now really happy to be back on the corporate venture side. BHP Ventures is not unlike what you heard from Dan. So we've been around for some time. We're sort of in our middle journey after the launch. As Lee says, we made our first investment in 2019. So about 7 years old, which is really exciting and definitely gaining some maturity. Looking forward to talking more about the types of things we're investing in and what our purpose is, but definitely how we've evolved, I think, within BHP and are going into more portfolio management while we're still actively deploying capital is a great point of reference. And I'm looking forward to talking with you about that today.
Great. Thanks, Laurel, and welcome, everybody. So I'm going to start with some questions and maybe toss the first one to Dan. Pre-approval, how do you secure internal support for launching a CVC in the very early days? And, maybe talk a little bit about some of the key steps that ultimately, you had to work through with your stakeholders as you started, with RTX Ventures. And then Laurel can chime in, BHP and prior experience as well. But Dan, you want to comment on that?
Yeah, absolutely. And I've seen this at a couple different organizations, and I think first and foremost, you have to build kind of a sense of urgency for it within your organization. There has to be a reason, and folks at the leadership level have to believe that this is important for the company as a tool to build. Without believing in why the company should invest in startup companies, it's going to be a very difficult task to set this up. So that, I think, is the beginning. But with RTX in particular, a lot of the pre-work was done before I was hired. I was hired to help start the group, but they did a great job in, I would say, 2021, prior to our launch, doing background work, doing benchmarking. This started with discussions at the board level and with the senior leadership team. After we had a merger, you can look back at the history, but we became the aerospace and defense conglomerate when United Technologies and Raytheon merged the aerospace and defense assets and spun off the industrial assets and became a pure play aerospace and defense company. And when they looked at that and they saw the synergies of technologies that can fit across commercial and defense markets, they said a tool like this would be really helpful to be involved in the tech ecosystem in a way that we're supporting companies and working with them, and then finding ways to bring those technologies into the company or partner with these companies across our whole corporation, and that a tool like this would be very beneficial. So that was the beginning of it. Then they tasked our head of corporate strategy to do a deep dive on what are best practices, how might we set this up, what are some of the different common options that corporations use, and what are the advantages and disadvantages with respect to how RTX operates. And I'd say really they did a great job, because once they started hiring externally for a leader, I looked at some of their plans. I really liked the basis and the mindset that they had. And they were also very willing to take input from me as a prospective leader of the group, to take insights. What do you think of what we've done in terms of the background information? What would you do differently? What are some of the best practices? And that gave me an opportunity to give my input based on many years of looking across the industry, being involved with GCV and seeing hundreds and hundreds, if not thousands of corporations that have done this, good, bad, and ugly. And so I think it really starts from the top. Ultimately, I think one other nuance that was very important is that our CEO, in 2022, this became a piece of his goals throughout the year. So the board was monitoring how did the CEO set this group up, and what was the progress on that. And so really the alignment came from the top down, and that allowed me, when I joined, to formally launch the group in early 2022, to then go around the organization, set expectations on what we were planning to do, what we were going to do, and then provide continuous communication updates over the subsequent year, 2 years, on our progress, and then using tangible examples of what we were doing to benefit the corporation. So I'll stop there, but certainly could dive in deeper.
Just a little bit of pressure from the CEO.
Yeah, that's right.
Great. A lot of support too. So
there's a lot of support, I would say. Less than in our case, it was less pressure, more support, and really open-minded support is what I saw as a best practice at RTX.
Yeah, that's great. And that gets to something I'm sure Laurel will comment on, is, getting the executive support is key. Maintaining it is all the more important. And I would say that, one of the big challenges, the reason this first 3 years is so critical, is that aligns to the typical executive tenure. So, you got a lot to prove while you've got those executives, so that you can expand beyond the one CEO that brought you in. So Laurel, comments, and then Jonathan.
Yeah, definitely agree with Dan. Building on his comments, making sure that you have the right executive support. So Lee, for sure, CEO and my reporting group in particular is my C-suite member is the Chief Development Officer. So I report into the strategy team, also very well supported by the CEO. I think today we were really looking, and as the exploration that Dan had mentioned for RTX definitely happened at BHP before I joined as well, in preparation for starting the group in 2019. And I think truly has only gotten stronger, because what we're doing is really filling the gap where R&D and our innovation team may not be seeing some of the trends that are going to be affecting mining and our industry and the global resources industry more broadly. And I think nobody can deny that in today's world, technology is moving at a pace that we've never seen before and disrupting industries in a way that I think is hard to predict. And ventures becomes really the tip of the spear to understanding that gap, providing clarity and perspective specifically around new technologies. So I think that's a really good news story for global corporate venturing today for all companies in all industries, frankly. And again, that being an original thesis of ours when the group was started in 2019, it only is now becoming clearer and clearer in sharper focus.
Great. Jonathan, anything to add in the early days, kind of the pre-approval phase?
Yeah, I think it's in short, if you're talking to your executive team or you're evaluating an opportunity to join a CVC arm that's in its infancy, it's critical to get an understanding of how patient leadership is planning to be with the development of this new business line at the company. The idea that 3 years in, you're going to have a bunch of exits to demonstrate the financial value here is, maybe you'll get lucky, but this is a long game. And I've seen, lots of CVC arms in my career because we at Fenwick help structure these. So we help actually build the legal infrastructure that goes with these and then help them deploy their capital. So do the actual investments, right? And I've seen so many CVC arms that start with a bang and have lots and lots of plans. But the leadership, that sits above the venture team, if they don't have the patience to see these investments through, the easy thing to do is pull the plug, right? And so I think coming into it, doing this, there's lots of great reasons to build a CVC arm, and it can be really effective. But if folks aren't willing to stick with it over the long term to see it through, and if they don't really understand the importance of that up front, you're in for a short ride.
Yeah, very good. And I don't know if I mentioned earlier, but that patience cycle, you need to show progress in the first 18 months. You have to have real results in the first 3 years, but investments can take 7 to 10 years to bear any fruit, and many of the losses will come before the gains. So it's definitely a tough start. Let's start to dig into if you can kind of transport yourselves back in time. What are some of the things that you did to develop the pitch or the plan? What are the key building blocks that you had to put in place as you started to launch your CVC program? And Dan, you want to go first?
Sure. I think there's definitely several aspects. One is people and process. So luckily, my company realized before we even launched that we would have to operate a little bit differently than typical organizations within the structure. And so again, as I mentioned, different options, they looked at different options of how to set up the group, whether it should be external or an internal separate subsidiary, and how HR practices might be slightly different in order to attract the right talent. And they really took a very wide scope of what was possible. And I think they arrived at a very good balance of, having some flexibility in order to attract and retain talent. But also in this case, we are, an internal fund investing off balance sheet and really, tightly intertwined with our technology organization. And then to the question that you were asking, Lee, we also had to get a real cadence with our legal teams and our finance teams and accounting teams to start early and say, how is this going to work? And it certainly made them uncomfortable to some extent with the unknown of what we were going to embark on and how we were going to do it. But we had to just very carefully, with a lot of meetings and a lot of examples and kind of historical experience to describe how we saw some of these things playing out. We just had to get people comfortable and then start moving on real deals, and then use those as examples to build a muscle within the organization that could be replicated and also adjusted to help appease the different stakeholders' needs, which was extremely important. And as we did that more and more, you could really see this getting established and a lot more comfort across the organization. Did that answer your question, Lee?
Yeah, I think that's good. Yeah, that's great. Laurel, you want to comment?
Yeah, I think one of the things that the team had identified early on in the early days of BHP Ventures was that it was really important to have two arms internally of the ventures group, and that was investments and portfolio. And they set that up very early on. The portfolio team's incredibly important because once the investment is made, they take that investment and then drive value back to BHP. We are a strategic investor. That means that we have to have strategic benefit that's being derived by the company. And early on, we said, how are we truly going to derive that strategic benefit? And it was about how we were interacting with the technology companies with our assets, so directly involved with our assets. And we weren't going to have connection to our assets if we didn't have a portfolio team that, as we've been building it out, is co-located with our resources, both on many different continents. And so I think that was early insight by the team, and we've only continued to build on that now in our 7th year. And I really appreciate the forward thinking of how we were going to accomplish our goal, and then functionally with teams that were being created to ensure that we're driving those results.
That's great. Maybe, Jonathan, this would be a good time for you to chime in a little bit about some of the different decisions that folks can make about how to structure a CVC and things they may want to think about in their very early days when they're considering options.
Yeah, absolutely. So I think once you've done what I would consider the harder work of getting the buy-in and the investment thesis and sort of figuring out more of the organizational structure, which deals with how people are who are various people going to report into, what are these teams going to look like, then we can start to put a legal structure in place that will support a lot of the goals and a lot of the other things that I've just been talking about reporting lines and how information is going to be treated and things like that, and how people are going to be compensated is really critical when we think about structure. So I like to think of structure as kind of a spectrum, if you will, but there's really like 3 core choices to make. There's some variability, but at its simplest way to think about it is there's 3 core choices. So the simplest structure is a fully integrated structure. And by that, I mean we have our mothership, so our parent company, and we have an operating business that sits within that parent company. So you could have your own email addresses, you could have your own business cards, we could, call it, Mothership Ventures or whatever we want to call the thing. And you can set up internal reporting lines and have a standalone budget, but there is no different legal structure. It is the mothership entity, right? So you have one entity and you're just an operating business within the structure. Benefits of that are, one, super easy to set up. You don't really need you don't need another entity. You have your existing entity, and it for brand new CVC arms can be the most palatable thing for leadership because on the one hand, if you remember, I said it's really important for folks to be patient. Sometimes executives are more willing to get on board if they think that they can cut this thing entirely if it's not really working, and so it's easier to stop a business internally if it doesn't have its own legal structure. I mean, I would say it's sort of marginally easier, so maybe that's a selling point. Also, it's pretty simple in that instance. It's going to be, annual salary and some kind of a bonus structure. You're usually not going to see synthetic carry. You're certainly not going to see real carry, though real carry is rare in CVC land. But there are limitations of this very simple structure. One, while you can identify yourself to the world as Mothership Ventures, when it comes time to sign investment documents, it will say Mothership Inc. And that can raise questions to potential portfolio companies and other co-investors and folks in the space about how serious is the mothership about actually pursuing this new venture arm. And there can be issues with conflicts or with managing information. It's all solvable with firewalls and policies, but easier if you put some legal structure around it, which brings us to sort of an evolution of the structure, which is a subsidiary, an LLC subsidiary. And I would say that, this is just, you got your mothership up here and you just drop down a wholly owned subsidiary. The venture team works for that wholly owned subsidiary. That subsidiary is the entity that signs all the investment documents. And this is the most common structure that we see in CVC arms, because it's easy to close down an LLC, but it gives you separation, which is something that you can project to the market, to your portfolio companies. And because you have a separate legal structure, you can have folks that are employed just by that entity, which allows you to create, your own HR policies and things like that Dan had mentioned earlier. It allows you a lot more flexibility when it comes to compensation and doing things that are either, outright carry or synthetic carry and things like that. And when it comes time for you to be hiring, because again, you're not just trying to project the sort of gravitas of this new CVC arm that you are creating to potential startups and to other co-investors. You are also trying to project the seriousness of this venture to folks who may come and work for the CVC arm. And a benefit of this structure where it's, Mothership Ventures LLC, right, is again showing that the mothership has bought into it more. The last structure is a single LP structure, which is a venture fund. It's a traditional venture fund where the mothership is the sole LP. The benefit of this is it is truly and completely separate from the mothership, which can help for accounting purposes, but you can also achieve the off-balance sheet investment structure from an accounting perspective if you have a subsidiary. And it also, I think, sort of shows that, hey, this is truly a separate thing. It allows for carried interest. And again, it sort of ups the, just the distance that you can put between the venture fund and the mothership. That's also the downside of the structure. When you are really so separate, it can be challenging to feel part of the broader organization. It can feel challenging to demonstrate value. There are ways around it, but structurally, you work for an entirely different company. You don't work for the mothership. You work for this fund that was set up separately, that will have its own GP. And so the challenges that presents is, how are you going to be able, when you have such a separate legal structure, how are you going to find the value in the integration, which is going to be essential to ensure that the mothership as the single LP continues to fund the operation and continues to support it. So the single LP structure, it is not generally, it's incredibly rare for us to see that as the foray into a CVC's existence. It can be an eventual evolution, and it depends really on how I think who the investment professionals are at the CVC arm, how management at the mothership is thinking about this, and whether it's going to be focused more on kind of financial returns and a branding play for the mothership as compared to extracting, or at least benefiting from a lot of the strategic value, sort of the things that Laurel was talking about earlier.
Yeah, that's great. Well, thanks for that overview. I'd say in all of those, you still have to deal with your investment approval process, your kind of your fund size, who you co-invest with, your innovation strategy horizons. And I'd like to hear a little bit from Laurel and Dan about how you approached, kind of what's your sweet spot for investments and where do you begin? Because you both come from huge corporations that have multiple business groups, many different priorities. But tie it back to your charter and what's your advice for where do you start to make sense of, like, do you do LP positions? Do you do direct investing? Do you do both? Want to comment a little bit about that? Laurel, you want to start?
Yeah, absolutely. First on the sort of how we think about what we invest in and where we position ourselves within the company is we decided early on that we were going to be very close to the CEO's business objectives. So we receive strategic business objectives from the CEO's office, the entire company does, and we line up under those in terms of prioritizing what our work is. And I think that's really been beneficial for BHP Ventures within 90,000 people across a 140-year-old mining company around the world, because we speak a common language. So when I speak to other departments, if it's a copper mine in South Australia or a potash mine in Saskatoon in Canada, I can say we're really focused on this particular strategic business objective. And that allows us all to know what that means and why we're doing it, and then how we're enabling that particular success of that particular objective. And that has been I think, a very good tack on our part. Specifically as organizations grow and change and pivot. Of course, I think old mining companies maybe grow and change and pivot less quickly than technology companies. But we're always looking for how we're going to continue to do things better. And so by ensuring that our investment thesis, the way that we hire, the way that we talk externally to the market are aligned with these objectives, and that our communications, external and internal, are aligned with these objectives, I think it's really been a good way to stay on the same page with the most senior executives in the C-suite, but also with folks who might be operating mines at site who are really just thinking about operations of bringing a particular ton of commodity to market, and that's what they're aligned with. So understanding not only where you fit in the organization, as Jonathan mentioned, there are different ways to do that. I think when you take the next step about outlining strategically what you're going to be focusing on the company priorities have been a real measure of success for us.
And Dan, I see you nodding your head. I know you had a similar approach. Practically, where did you start when you started doing investments? Because you did the first deals when you arrived.
Yeah, so the core part of our charter, as really laid out by the board and the senior leadership team, is to build a tool that really supports our technology organization and the tech roadmaps that they build and maintain each year, which really look at what are the key technologies that are going to influence the next decade plus of both aerospace and defense industries. Okay, so this is a very broad mandate that they have, and they support that with a number of R&D programs and engineering priorities across the whole company. We're now a tool extending externally, looking for investments that can complement those strategies and lead to new opportunities for the whole company. And so embedded in what I just said is there's many stakeholders across an organization like this. So not only do we want to be true to the charter and support the tech roadmaps with investments, we also want to be relevant to the three businesses which span Pratt & Whitney aircraft engines and associated technologies, Collins Aerospace, which is a broad swath of capabilities and technologies and products that go into aircraft, both commercial and defense, and then Raytheon, which is our key defense business. So we're trying to be relevant to these stakeholders with our investments. And then beyond that core charter, I also believe that a venture arm can do other things, which can look at other business priorities as well as core capabilities for the organization, like manufacturing technologies, enterprise technologies, et cetera. And so we also want to spend some of our time on looking for investments that can be utilized for these other needs for the whole company, so that we're relevant to a broad array of stakeholders. So that's really what we've been focused on, which is a lot of stakeholder management, understanding priorities across these different organizations, and then finding good examples that resonate with these different groups, both from an investment perspective, but then also cultivating the partnerships that we ultimately would like to create, with these outside companies.
So, I mean, that's great. I'm trying to just think back to like your first year and a half.
Yeah.
Like, what does that look like in terms of the deals that you bring forward? I mean, how important is it to just get started so you can have those, like, it sounds like you're talking about teachable moments, versus getting everything right? And I don't know if either of you have, or Jonathan also, anybody has experience on that, but there's a lot of moving parts here, and what you said sounds great. How do you get started with all that?
Well, I'll just briefly, I'll just comment that to be relevant as a CVC unit, I believe you do have to make investments. So that was key to what I talked to my team about is, listen, we're stood up to do this. They want to deploy capital. We need to go and find investments. Then you have to say, I can't just make any investments. So it really starts in that first year with building a robust pipeline where you can truly demonstrate a filter and discern between what is attractive and what is not attractive, and only bring forward some attractive deals, and it has to happen fairly early. And this is twofold, because by doing a deal, you build those muscles, across the organization that you need to work with. That's critical to establishing your CVC unit. But secondly, you start to put points on the board with strategically relevant deals that, like I tell folks internally, you want the leaders in the organization and the leaders in the business to look at your deals and say, I know why we did that. It makes sense, right? And so that's in that first year, it's key, because you can't expect results yet, whether it be strategic or financial, but you can expect to, use a good strategic filter and have good examples of companies that are related to the key priorities of different parts of your organization that you want to be relevant to. And then by doing those deals, you're helping the other parts of the organization that you need to coordinate with, build their strength, their muscle, and learn.
That's great. Great. Perfect. Thank you. And I'm gonna weave in some questions from the audience, and we're welcome to add more questions. I have two questions, but let me start with Nathan's question. How did you approach generating deal flow early on, and what actually moved the needle in getting your name known in the venture ecosystem? Laurel, you want to talk a little bit about that? How you get deal flow?
Absolutely. I think a number of folks on the team when I started that came in sort of about 6 months after I started, that I recruited to the group, had been professional investors, both in the private and had some CVC experience, and so came with pretty deep connections into the venture community. In addition, we did spend time strategically thinking about our ecosystem and stakeholders and the types of deals we wanted to see that we thought, again, would benefit the way that we had been positioning our investment thesis. So again, around our initial strategic, or our company strategic objectives. And then we said, who are the stakeholders who are investing in those types of deals we want to see, and what are the connections into those, and how do we better understand, how they're sourcing their own pipeline and deal flow. And as a result, I think a culmination of things, both speaking on panels, getting our name out there, individual meetings, as well as leveraging existing contacts, were very, very helpful in establishing who we were as a brand and positioning. I think making sure we're seeing all the deals in the relevant space that we want to see continues to be a challenge. So we always, say, was there any deal that was done that we hadn't seen before? And if so, why didn't we see it? So I really think that's an area where we're just constantly making sure that we do have visibility. And in the world today, I'm sure in defense tech, Dan can talk about this, like lots and lots of folks, new folks who've sprouted up in that area and who are investing in those areas, who have lots of different types of backgrounds that may be different than traditional aerospace and defense, that don't necessarily come from Dan's world. Same with mining. Lots of folks investing in mining who don't have a background necessarily as miners or operated mines or even junior miners or explorers. And so again, that's a dynamic ecosystem, I think, that we need to continue to challenge ourselves to ensure that we're seeing the best deal flow. So early on, making sure we've got the right team with the right contacts into the right ecosystems, and making sure we're developing that, and then continuing to iterate and making sure we see the right deals.
That's great. Maybe, Dan, you could take the lead on this next question. Could you talk a little bit about what your approach was with your early hires, and how you constructed your team, some of the roles that you put in place?
Yeah, absolutely. So we have a team of 8. One thing that I was adamant about is I wanted to stay small for as long as possible. And that's from looking at, companies over many years. Didn't want to get too big too fast, because the wins that we can develop really do take time. And, just keeping that operating budget at a reasonable level as long as possible, I think was important to me, the way that I wanted to set it up. And so what did we do is, we started with folks that had some transaction experience, that could lead deals end to end and know how to work across different stakeholders. And we also brought in folks that had good experience already working with the technology community, with the connections, so that when we saw a new deal, we could really penetrate deeply into subject matter experts and get really high quality feedback from folks across the organization. So kind of a mix of both internal and general transaction experience. And it was really just, 3-4 of us for a while in the beginning. And then we would carefully add as we, could feel bandwidth starting to run thin. As the portfolio started to become larger, we started to add folks at various levels of experience with transactions. And then ultimately, I think once we approached about 20 companies in the portfolio, we hired a dedicated portfolio development leader so that we could lead the whole portfolio and unify all the projects that we're starting to build between parts of the business and our portfolio companies, and do that in a holistic way. And so, now we're up to 33 companies in the portfolio, 8 team members leading various aspects of new deals, portfolio management, portfolio and kind of project development, across the organization. And but I would say the key tenet was to grow slowly and carefully.
Great, thank you. Going back to, there's another couple participant questions I wanted to cover. So one is a brief comment on the optimal stage of startups that you target as a CVC, and your thoughts about what stages you target. Laurel, you want to comment on that?
Absolutely. So we actually have a pretty broad mandate in terms of stage. We will invest in pre-seed, seed, Series A, Series B. It's pretty broad for a corporate venture capital fund. We find that sometimes the pre-seed stuff is so early that we're better off talking with them, but waiting until maybe seed, then get a little bit more validation around the table. Although if they're solving a problem that we think is pretty interesting for our space, we might do a little bit of pre-seed. And I think that really has to do more around impact. So for us, we've got a broad mandate about when we can invest, because we want to ensure that we're seeing all of the companies that are going to be impacting the resources industry, and that we then get to be able to invest depending on when our entry point is and what we are targeting from a financial return perspective as well, enter at any point during that value chain. So we don't want to necessarily be restricted by a stage when there may be an opportunity that's either earlier or later. We're always thinking about what the strategic rights are that we're able to receive in exchange for our investment. And sometimes we can maximize those strategic rights earlier on in the process before there are too many capital providers around, and sometimes we can at a later stage. So it's more driven around what we can achieve rather than stage.
Yeah. So, and it sounds like you kind of keep in mind, or maybe I'll ask this as a question. Do you have a kind of a construct for a portfolio construction model in mind of the numbers of investments, or the, a distribution of stages, or kind of across the business groups, kind of how do you view what's important for the portfolio overall for your parent organizations?
Absolutely. We do have a fund model internally, which we updated. We actually just went through an updating exercise just a few weeks ago, looking back over the last couple of years, looking at what we had expected to receive. We've had some returns and some monetization events as well, which has been great. In terms of, we target about 5% ownership in the companies that we invest in. And so that leads us then over capital deployed, how many of those could be earlier or later stage. And then going back and revisiting, annually to say, what's sort of been reality against plan, and a plan really being an idea of what would be optimal results. But clearly it's more about the actuals. And then I think in terms of outcome and tenor, certainly we're, again, as a 140-year-old mining company, I think we are very much patient capital. We're used to deploying capital and having a very long lead time before we receive any return on that capital as a result of, what even just takes average of, I think, 27 years to build a mine in the United States right now. So that's very, very patient capital, which I think is good. And so as we sort of think about the horizon, we're expecting these things to not return significant dollars in a short time frame, and then that allows us to continue to build over a long time in terms of inputs to our model.
Yeah, that's great. So, and I want to draw in Jonathan with a little bit more of a sense of where are the things, Jonathan, in the early stages that you see that corporates need to focus on that maybe surprises them, and the things in the they've established their structure, they've done their few first deals. Where do they start to stumble or potentially risk challenges?
The thing that I see the most, and I'm sort of reminded of Bill Toronto, at Merck, where he says, often like the way to ensure that you're going to build a successful CVC arm is to communicate, and then once you think you're done communicating, communicate some more. And so what I have seen is that you spend a lot of time thinking about strategy, thinking about sort of a fund model, right? That Laurel had mentioned. And you sort of do some investments, and you try to talk about them internally, and maybe you did a little bit of a roadshow, and then you kind of hit a pause and a lull where you're trying to figure out what sort of your next steps are. And I think it's like in hardware startups, like Elon was a big espouser of like you hit this valley of death kind of thing, and not to over dramatize it, but like that's a big risk that I see in CVC, where it's not about, oh, well, we have to deploy more capital and we have to do more deals, right? It's about you need to be constantly, even when you are enshrined within the organization, talking to folks in multiple business lines, talking to your leadership team, talking about the investments that you've made, learning more about the investments that might be valuable to the company, the problems that they are seeing. This is a bring your lunch pail to work sort of everyday kind of grind, and you need to treat it that way. It's a marathon. And so you have to build that into the muscle memory. And if you don't, and people start to forget about you, they'll be like, what are we doing with this thing? And so I think that also comes to stage, right? To go back to that earlier question of like, what stage should you target? I think coming into it with maybe having some like minimum viability of companies that you're willing to look at is a good idea. But anything beyond that, when you're starting a CVC arm, is just it's not gonna be particularly productive. If you say, oh, we're only going to focus on late stage investments, well, that's going to require a ton of capital from the mothership, and good luck. Those deals are not going to be easy to get into. And the way that you can build credibility is exactly, the way that Dan had talked about it, right? You build it slowly, methodically, deliberately, and consistently. And that will require you getting into companies, Series A, Series Seed, where you're going to have access to more opportunities.
Great. So Laurel or Dan, looking back at your first 18 months, if you can kind of transport back there, what are the things that you saw as essential to building credibility and momentum? Any other thoughts about that, or any friction that you encountered along the way?
I'll start real quick. I think in the first 18 months, demonstrating clear pipeline was important. The number of companies in the space that we were looking at, very important, and we tracked that. Showing some very good strategic companies that we did invest in, very important. Making the direct connection and tie to who in the RTX organization was this relevant to, and then over that first 18 months, showing a body of kind of collaborations that started to emerge, and showing that was growing. Those things were probably some of the most key metrics that we were looking at to demonstrate traction and progress, because ultimately those connections with the company are the most important. And then I would say that what transitioned there as you got closer to 18 months plus was also how were these startup companies performing financially? Because we do have a balanced mandate of, ultimately this is strategic investing and we want to create new options for the company. We also want to deploy capital very smartly and have strong returns from our fund overall. And I think if we do both of those, we'll have a long-standing tool that will support RTX for a long time.
Excellent. Laurel?
Yeah, I think the roadshow concept and just making sure that you're known to the key stakeholders. So stakeholder mapping early on was really important. And again, that stakeholder mapping continues to evolve because people change positions. So even when you do the stakeholder mapping initially, taking out and refreshing it, and that's something that the woman who runs the portfolio team within Ventures does, annually, and then her team is assigned to different stakeholders. So who are those stakeholders early on, and then how are you going to get to know them? I've spent lots and lots and lots of times on airplanes, traveling all over the world, getting in front of those people. And I think despite the fact that many of us are on Zoom today, there's really nothing like being in person with people, describing what you're doing, and then making sure you've got the right touch point with the right stakeholders at any given time. I love what Dan said about being able to show what your companies are doing, and I sort of look at it as tell stories around your golden thread around value. And we do that in lots of different ways. One important one is case studies. So being able to say, even early on, being able to say, these are the things that the company is able to develop and how their product is evolving in the first 6 months of our particular investment. And we learned a lot from the way they're pivoting to where the marketplace is developing, which is dynamic. And that's helping us think about our own pipeline. For example, that could be an early stage story that you might tell after you've made 6 months into your first investment. So really thinking around telling stories of success and strategic value. I also have a dedicated comms person on my team who came internally from BHP, and she's based in Australia. She's very good at telling stories the way that we like to hear them internally. And I find her and her positioning and pitching to be just completely valuable beyond belief. And so I would encourage people also to think about who your audience is and what kind of person you need to have internally to be able to tell that story.
That's great. Thank you so much. And there's so much more that we could talk about. We've kind of just scratched the surface on this. As we close our time together, I want to thank our panelists for sharing what they were able to share in the time that we had. We didn't get to all of the questions, but you kind of alluded to them. There was a question from another Australian about how you keep the mothership on the opposite side of the world, bought into the CVC ecosystem and mindset. I think Laurel just commented on that, and Jonathan's comment about communicate is dead on. Dan also earlier referred to the resources of GCV and the GCV Institute. A lot of the things that Jonathan alluded to with the operating models are covered in the Institute's courses. We actually have several Institute courses coming up. I'll mention briefly that the next wave webinar will cover up some of these other topics. There's the symposium coming up in London next month with a number of speakers, and tied to the symposium, we have one of our investment programs courses. The CVC investment programs course is the course that we spend a lot of time talking about these operating models, structural decisions, team composition, performance metrics, and things that Jonathan, Laurel, and Dan each alluded to. There was also a question in the chat about kind of how do you land the value and realize the results of this portfolio development that Laurel was just talking about, and Dan alluded to. This is a course that we offer twice a year, the landing of value of corporate venturing. And we also didn't get into the discussion of governance in very much detail, but we have other courses that we offer around being an effective board member and board observer as you start to take on these investments and you're monitoring their performance as a board observer or perhaps as a board member. So lots of courses that are available. We also have an active network of regular programs to support our community of alumni with various courses and offerings. We'll have that for all of our alumni. So these courses will be available to you. We'll send you a follow-up note to list some of the specific dates. But if you're interested in this topic, I strongly encourage you to check out our courses, reach out to me. I'm sure the panelists wouldn't mind having a reach out on LinkedIn if you have specific questions. But that has concluded our time together. Thank you very much, and good day for everybody.